Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest and author of the Options Playbook. All right, so our theme on the stock play of the day over the last, I'd say 3 or 4 weeks, has been bottom picking. So last week we looked at Occidental Petroleum, one of the Warren Buffett favorites in Berkshire Hathaway, and we talked about selling a cash secured put to potentially buy the stock at a lower price. Basically, in an area, one of the tranches that Mr. Buffett actually bought a lot of stock at. He added to his position last week and is still fairly, obviously bullish on OXY. So what we were kind of hoping is for a little bit of a movement to the downside in OXY and the potential to buy 100 shares of stock at a lower price. Bottom fishing. One of my favorite bottom fishing strategies is to sell cash secured puts, saying that I'm willing to buy the stock at a lower price if the market does come down to that level. Now, you can do this with a limit order. Say I want to buy 100 shares at that price. But the one thing about a limit order is you don't get paid for saying that you're willing to buy at that price. One of the upsides of selling a put is that you actually bring in cash now saying that you're willing to buy an underlying stock at a later date at a lower price. Now, the downside is that if it does come down to that price, you don't get the stock right away. You get it closer to the expiration date or at the expiration date. But you do get to bring in some capital now. And if you are incorrect in your forecast, well, at least you get that little pillow of capital to move on to the next trade, or maybe go out and sell another cash secured put, hoping to pick the price a little better the second time around. So there's not much to say as far as Occidental Petroleum is concerned. I'm going to run to the option chains here inside of Ally Invest. When we did the trade last week, Occidental Petroleum was trading at 62 and change, just a little bit. Right now we see it at 63 and 7/8. So the market hasn't came down in Occidental Petroleum. So I don't know, is that good news or is that bad news? We sold the September 56 strike put. So I'll scroll down and I'll highlight here inside our option chains that this is the call side, this is the put side. That expiration is September 2nd. We got 17 more days remaining. We sold the 56 strike put with a couple of point movement on the upside. We've actually done fairly well on that put. We sold it for $1.10, and at this point in time, we've made about half of that premium. It's trading right now at, we'll call it 42 cents, right at the midpoint. But this is the option contract that we sold. Not really an adjustment that we would look at. We would like the stock to come down. Our goal was to buy it at a lower price. But if the market stays where it's at, we at least get to collect the premium. Not meant to be a recommendation, as always, here on the stock play of the day. But when we're looking at these type of strategies, what we're trying to say is that let's take plays inside the options playbook and apply it to the current market conditions. And in a stock like OXY, where it's had a fairly decent run up a lot because of the new, Warren Buffett had a lot to do just with the movement in general. And if the stock did come down to the lower level, we're willing to buy some more of it. At this point in time, we're up about half of the premium. We made about half of the premium that we sold it for. So you just stay the course and you just move on, and we'll come back in September and see, well, did we get the opportunity to buy the stock or did we not? Now, I'm going to stick with that theme this week too, but I'm going to do a little bit of a fancy trade here for the stock play of the day. This strategy actually doesn't have a name. And we had a different strategy when I wrote the options playbook that I've talked to a lot about. That was a very popular strategy, and that was buying deep in the money call options and then selling shorter term options against that position. Some people would call it a leveraged covered call. We came up with the name Fig Leaf for that strategy, and it's kind of taken off a little bit. And the main reason why is that it's not like doing a covered call. You have the right to buy the stock, but you don't own the stock. So we like to say you're kind of covered, and hence the fun name, the Fig Leaf. And in this strategy, though, I'd like to come up with a fancy name for this strategy. But what we're going to look to do is stick with the theme where we're kind of bottom fishing. We're selling a put, but in this instance, we're looking for oil, and as the title says, to bubble up. In the short term, oil has been beaten up. Do expect a little bit, hopefully, I guess the concept would be the good old phrase, the dead cat bounce in oil, but ultimately maybe a little bit more bearish as inflation concerns wane, as we get into the new year. But right now, what we're looking to do is say we're going to, if oil does come down, we'll use one of the ETFs. We're going to use USO today. Another one to look at is USL, but USL, which is long-term oil based off of long-term futures contracts, does not have the option markets that USO does. So we're going to sell a put saying that if oil does come down, today it's down about 3%. Barrels trading, I checked before we came on, a barrel of oil is around $87, down 3% today. We'll say that if it comes lower, we'd be willing to buy the USO at a lower price. But in the short term, in case we get that little bounce, we're going to buy a long call spread. So we're basically selling a put to help buy a longer term, to help buy a bull call spread in the underlying. So a little bit fancy. Overall, you're bullish on the USO, but you wouldn't mind buying it if it came lower. So that's one thing that's so awesome about options is if you have a forecast, there is usually a way, if you think about it hard enough or open up the options playbook, you can come up with a way that you can manipulate your option strategy to try to match your forecast. So I guess overall, our forecast would be longer term, we are bearish on oil to come down a little bit, short term, we could be a little bearish to be able to buy it. Longer term, looking for a little bit of a pop to the upside. All right. And long term in options is over the next 3 or 4 months. So we're not talking years in this instance. All right. So let's start by taking a quick peek at the market. I'm going to run over to my VIX watch list and I'm going to highlight we see the VIX below 20. So here's VIX right now is at 1980. It's down a minimal today. And we have the S&P 500 index up about 1/4 of a point. We had some strong retail numbers. Walmart came out. Home Depot had fairly good numbers on their earnings. Walmart, you would hope that Walmart would beat the street considering that they gave guidance to try to lower the numbers. So if they would have not beat this time around, I think that would have really beaten up the stock. So good to see that Walmart had some decent numbers. We have a lot of retail sales that's coming out this week. Target's going to be announcing. We have Lowe's. We have a bunch of different retailers that will give us a little hint, not only on inflation, but inventory concerns, which have been an issue. And yeah, what is the Fed going to be? The Fed's going to be watching these retail numbers a lot this week. Their next meeting isn't out until September, but we do have the Jackson Hole that's going to be coming up here in just the short term, and anything can happen at that meeting. Okay, so I find it interesting that the VIX, once again, we've been talking about it throughout the whole downturn. We never hit 40. I'm going to highlight it here on my chart. Never hit that, never had that capitulation moment. going all the way back to when the VIX, the big downturn, going all the way back before the pandemic, when we had the pandemic announcement. 20 was a line in the sand forever. We danced below it. Now we're back there again. So the VIX is once again not showing a ton of concern. I would actually say we're in a low volatile environment relative to well, I should, relative to the last year or two. And I kind of highlight that. We have the 200-day moving average all the way up around 24. We have the 20-day moving average up around 22, and the 50-day moving average right now around 26. So we're below all of those moving averages in the VIX. And when we're seeing that, the VIX is just not showing a ton of concern. Everybody keeps talking about a recession. The VIX doesn't seem to feel like that is the case. Now, we have September and October coming. There's a lot of seasonality. No reason for that volatility in September and October, but they've proven time and time again to be volatile months. And volatility doesn't necessarily mean the market's going down. In general, volatility just means that we're going to have wilder swings in the marketplace. So we've had a run up going into September and October. I think the seasonality is something to watch. Wondering if the VIX does actually make a little bit more of a spike up. To see it down around that 20 level, and the VVIX is trading at 87. That's also a new low for the VIX of the VIX, the volatility inside the VIX index. As a matter of fact, let's just add that to the chart real quick, like, and you'll see that we've also broken through on the downside on the VVIX. That is the volatility of the options that trade under the spot or the symbol VIX. So yeah, the VIX just isn't showing a lot of concern overall about the marketplace, even though a lot of people are talking about a lot of concern, and there's still debate if we're in a recession or not. Walmart, one thing that the Fed is probably one of the saddest people about Walmart and Home Depot's earnings, in that it doesn't say anything about taming inflation when you're seeing good numbers still from the retailers, still showing that the consumer is strong. And I think this will be a very important time, still on the cusp. Is the Fed looking in September to raise 50 basis points or 75 basis points? A lot of news between that now and then, but this type of good earnings reports makes the Fed lean a little bit more towards that 75 basis point move, maybe in September. Okay, let's get into the strategy. So I'm kind of excited to talk about it. Like I said, I can't remember the last time on the stock play of the day that we actually went this advanced, where we're going to actually combine two strategies. And here's the way the trade's going to look. We're going to do a cash secured put, much like we talked about in Oxy last week, where we're going to sell a put at a lower price in USO, saying that if it does come down, we'll be willing to buy 100 shares of that ETF at that lower price. Then we're going to take that capital, the approximately the same amount that we're going to receive for saying that we'd buy it lower, and we're going to do kind of a fear of missing out. I have a lot of analogies today, but and buy a long-term call spread in case we do get that dead cat bounce in the short term on the price of oil. So that's how we're going to play it. I like this strategy. I don't talk about it a lot. I don't highlight it as a specific strategy inside the options playbook. So I have to show you two screens. We're showing you the cash secured put screen, and then we're also going to look at the long call spread. So let's run back to the option chains. 1 second here. And we see right now that the USO is down about 2% today. It's trading at 71.43. So we're going to go out to the September 2nd date. We're going to stay with that same date. September and October are scary months to me. I don't think I really want to go out into mid-September. I don't know. There's no real rhyme or reason to it. So we're just going to go out 17 days. We happen to have weekly expirations in USO, and this, like I said, this is a liquid ETF. So the option contracts are very liquid overall. It's a simple thing to trade. So that makes it also more feasible because, you are, in this strategy, we're going to be trading 3 option contracts. We'll probably sell the put first and then actually go out and buy the long spread afterwards. I don't think I'm going to enter it all as one trade. I want to see what that execution is on that short put to try to determine what I'm willing to pay for the long call spread. So in this instance, we'll start, and our paper trade will be, once again, here's where oil is at, USO, I should say, the ETF. 70 strike, we're on the put side, 17 days to expiration, and we click on the little drop down and we're going to say sell. So in this instance, we're bringing in $2.14 if we can get somewhere close to the midpoint on USO. A little bit of a wide spread, relative actually, for this underlying. A little bit of volume, a little bit of open interest. Now we're going to go and take that $2, and you could just buy a call outright, but I kind of like the concept of trying to save a little bit of capital here. And so we're going to do a long call spread, but we're not going to risk a ton. Our risk is mainly to the downside. If the market flew through the 70 strike, and 65.60 would be put the stock at 70. So that's where our main risk is coming from. But in this instance, if we go and buy the 73 strike call then, and now we sell the 75 strike call, right here, we're going to be bringing in, oh, I'm sorry, 76 strike call. Say that's too big of a credit, okay? And sell the 76 strike call. We're going to have a 3-point wide spread. That gives us, that's our maximum that we can receive on that spread. And we're going to do this, we're going to take a little bit of the credit from the 70 put, and we're going to pay for this long call spread. We're still bringing in a net credit of $1.21 to the account, but when we do this entire trade, we're saying that if the market comes down to our strike, our 70 put, go ahead and put the stock to us. We're willing to buy it. That means that we have to have $7,000 in cash in our account if we do this and we're willing to buy it or trade it cash secured. If we do it cash secured, you can actually do this in a retirement account if you have the proper approvals. And Ally Invest, you can trade options inside your retirement account once you get approved to trade option contracts. And then you could use this to buy a long call spread. So I guess I'm going to make this the official paper trade in the right rail. And I'll put it all together because we'll come back next week and we'll take a peek at this. We could enter this all as one trade. There's no reason why you can't. Looking to get it done for a net credit of $1.20 to the account. But we're selling to open the September 2nd 70 strike put, buying to open the September 2nd 73 strike call, and at the same time selling to open that same expiration 76 strike call. Now, let's look at the profit and loss graph, but then I would go back and actually execute this as two separate trades. I would want to execute the put, see what type of credit I got, and then go out and try to work the long call spread. Okay, but for to keep things simple, I would just we're going to look at the entire trade all as one. And here's what our outlook looks like, okay? So, very interesting profit and loss graph, right? The underlying stock is trading right here. If the market comes down to 70 at expiration, we're willing to buy the stock. We have $7,000 in our account, less than that credit we brought in. By the way, we can use that to help pay for it, that $121 less commissions, which is the net credit that we received from doing this trade. And then from 73 on up to 76, we have the potential to make $300 on that trade, plus the credit that we received, right? So even though it's 3 points wide, the maximum on this whole gaggle of option contracts, we can actually bring in $1.21 in net credit, plus we can make a potential of $3 from our long call spread. From 76 on up, we do not have any more upside because we've limited it by selling that upside call option. So very interesting trade. Have never gone out and actually looked at this type of trade on the stock play of the day. We usually do stuff a little bit more simple, but all we're doing is combining the strategy from last week and basically doing a fear of missing out trade on the upside, saying that, yes, we kind of expect oil to maybe go lower in the short term, but in case it doesn't, let's go out and buy this long call spread. And we can be a little bit more bullish on oil down around that 70 level in the USO, which would be fairly close to the 80 level, I think, in oil, in a barrel of oil. And at that range, that is just a very interesting range for oil. There's been always on a barrel of oil, there's been a lot of support around that 80 level going all the way back years and years ago. So overall, uh, if inflation concerns are waning, we could see oil go lower. This is a simple strategy to try to bottom pick a little bit and also give yourself a little bit more upside in the short term. If you have any questions, which this is an advanced strategy, please feel free to put them in the chat box. I'm going to go check them out right now. And you can also talk a lot about OXY or any other trade that we've had. This is supposed to be an open outcry. Uh, benefit of doing this on the Ally YouTube channel. So we can answer any questions here. And let me go and check that out right now. All right. So Freebird is saying Warren Buffett bought a large stake in Ally also. Can we do options now? Well, as far as Ally is concerned, I can't talk about Ally for obvious reasons. But yes, that did happen. That was a headline today about Warren Buffett and his purchase of Ally stock. But unfortunately, I cannot comment on that. I'm just, it is an interesting news headline, and I guess we'll leave it at that, Freebird. Do we have any other questions today? What do you guys think of this strategy? Have you ever seen this strategy before? Because it is a little something different. Clinton's in there and say, I appreciate the more complicated fig leaf. I appreciate the more complicated fig leaf. Thank you, Brian. Well, I like the fig leaf too. I think it was a fun name. It actually came from somebody in the community. I think we need to name this strategy because I do also think that this is a fairly well, it's done often enough that this gaggle of option contracts really could use a name. So you're selling a put to buy a long call spread, and some people will adjust it too, where they'll just sell the put to buy a long call, and that's feasible in this scenario. But we're only going out to September. I don't expect a ton of upside in oil by that September 2nd date. So I would rather sell the call, get this thing done for a net credit to the account overall. Is the downside well protected from Simon? Simon, no, it's not. You know, and you can go back. I'm going to jump back to the profit and loss graph here real quick like. Okay, so this shows you the downside, and this is the benefit of the Ally Invest option chains is that we do have this profit and loss graph. And when you're doing a strategy, especially like this, where we have 3 different legs, each option contract is considered a leg, it highlights, and this is the dotted line is at expiration, is that you basically have the same risk as owning stock, right? If you bought stock at 70, you would have substantial downside all the way down to 0. And then on the upside, you'd have substantial upside. We've capped the upside in this strategy, but we still have that risk to the downside. And that risk would be that we put the stock and then the stock dropped precipitously after we bought it. Now, you can always just get out of the trade too. If the stock does go down, you can close these positions. There's no worry. You can literally, you could let the long call spread run and remove your risk by buying to close that put option. That's where all your risk comes from on this trade. All right. Well, that looks like that's it. Thanks for your questions. I do appreciate it. And that's going to be it for this edition of the Stock Play of the Day. We'll come back next week. This will be a very interesting trade to look at. It will still be alive. So we'll be able to look at the market quotes and talk a little bit about what happened in USO. Please click subscribe, ring the bell, and we'll see you this coming up. We'll see you next Tuesday for the next Stock Play of the Day. Bye, everyone.